Brilliant. Okay, Sam, welcome to the session. Let's start off with a quick introduction about yourself and Hambro Books.
Sure. No. Good afternoon, everyone. Thank you for making the time to listen to me, and thank you, Em, for inviting me to come along and chat. I myself am a founder turned investor, so much prefer spending time with founders and hearing about everything you're building rather than talking to other investors. So I work for a VC fund in town called Hambro. So we are an early stage and late stage VC fund. We invest everywhere from pre-seed all the way up to kind of Series B, Series C growth stage kind of funding rounds as well. I primarily look after the pre-seed and seed funds that we have here at HP. So we're looking to invest anywhere from kind of 250k EIS checks up to £2.5 million checks into kind of Series A, Series B stage companies from those funds in 4 kind of primary verticals. So fintech and insurtech under one umbrella, sustainability, future of work and education, and then digital health. As a firm, we kind of have this really unique position and infrastructure whereby we have early stage funds that are then supported by our late stage funds. What that means is that founders get a totally unique experience and perspective of fundraising and growing businesses through, because not only is there access to capital that most other early stage funds don't have, there's a big kind of team and resource infrastructure around Hambro Perks that means, you know, you're getting everything from advice to on, you know, go-to-market strategies to then actually whether venture debt is going to be good for you or not, because, you know, we have an internal team to do that. So it's a very unique infrastructure, very different from some of the other early stage funds out on the market. As I kind of alluded to, I myself, before joining the VC world, was a founder. I launched an FMCG startup back when I was at uni, scaled that business and grew that and exited that last year. And at the moment, I don't mind this being recorded on record. I'm definitely a founder hiding as an investor right now. I like what I do right now, but I'm just waiting for the next thing I want to go and do, and then I will be making the jump. So yeah, everything you will hear me say today and answer today will probably be quite contrarian to some of my other friends and people in the industry, mainly because, you know, I don't come from an investment bank background. I didn't study business at university. I kind of went out, did something, and then and now I'm here. So yeah, bit of a unique position, but hopefully that gives you a bit of an intro to me and Hambro Perks.
Love it. Okay, so I want to talk about you said the smallest check size you wrote was around 250k. Mm-hmm. So for founders that are pitching you between, let's say, 250 and up to around $1 million or so, mm-hmm. What are you investing in? What are you looking at to make your decisions at that point? And how far along are you expecting founders to be?
Yeah, it's a good question. So first and foremost is always team and always people. And this is something that is quite hard to tell founders sometimes. And obviously I don't go and say, oh, look, you're rubbish and therefore we're not investing. That's not what I'm saying. But what I'm saying is you will find investors will scream our way and make random excuses, whereas actually what they're really saying is that we don't think either you as a founder or sole founder or co-founder relationship or even early stage team are a good enough fit. I'll give you a real world example of this. We had a company that we took to IC recently, doing in a kind of cybersecurity space, doing unbelievably well from a traction perspective. It was a young sole founder, and then he had kind of 2 fractional team members who were alongside with him. And the thing that we could not get comfortable with is that the fact that these 2 individuals who were fractional wouldn't make the jump into the business full time. They were, you know, one of them was a very large software company, which I won't name, and then the other one had done loads of stuff in a kind of CRO role, and, you know, the salary expectation was just huge. And for us, it was just a signal really of, as a team, where their heads at, how they're going to go and work. So team is always the number one thing that you look for in an early stage startup. In terms of having traction and bringing something to the table, it's a hard one because, you know, most of the founders I speak, and I'm going to say this quite candidly, most of the founders I meet don't need money, they need advice. They're just not doing the right thing at the right time, or they're doing it in the wrong way, and it's just kind of refining this and testing it. most people, when they say, okay, I'm fundraising, and you say, well, what's it for? It's usually team. It's usually for expertise that they themselves don't have. With the rise of, and in particular, that often translates to be technical expertise. So I find a lot of commercial individuals who say, look, yeah, I really have done everything I possibly can. I've built a wait list. I've got people interested in this really shoddy MVP that I've maybe built myself, and now I really need to go away and develop something. And that's totally fine. However, in most instances, there's a smaller leap that can happen. And I get it. I remember as a founder, you want to go from 0 to 100, whereas actually that kind of pre-seed and even sometimes a seed round needs to be 0 to 50 or 0 to 75, right? And that can mean, having using a no-code tool to build some sort of solution, and then having a dev kind of come in. But in terms of sorry, Emma, kind of gone off tangent here, but I think that the key point around this is when you're looking at early stage startups, having something to demonstrate that people are actually there willing to pay, or that they're interested, is really, really key. There's obviously a sliding scale, right? There's, going away and doing your own research, your own data, and understanding your ICP. And then there's actually having paying customers and the kind of caliber of those customers that kind of goes on a scale as well. I think the landscape has definitely changed. I've only known the VC world from 2021, 2022, and 2023. So I've seen like peak of the roller coaster, everyone having a great time, to now everyone being like, the world's going to end. I don't know what we're going to do. And in that kind of change and that inflection point, I've seen, everything go from, yeah, you can raise, and I did it as an angel investor. I wrote checks into rounds, 2.5 million pre-seed round, where they had nothing other than an idea, and they were exceptional individuals. Would they get that money now? Definitely not. That would just never roll. And so I've seen the market change firsthand, and the expectation now is that there has to be some sort of you have to be able to demonstrate your execution ability, right? That's the key thing at pre-seed. So yeah, hopefully that answers those questions.
Going back to what you said on the team part, how do investors view founders saying, hey, this is the founding team, and we want to bring on this person as our head of marketing, head of engineering, and they're committed once we've closed the investment round? Like, should you have your team lined up for when you close? Yeah,
I'm a big believer in, yes, you should, because there's often a deck runway, and then there's the realistic runway, which is, yeah, this money gets us 18 months. But what that doesn't account for is the fact that it's going to take 3 to 4 months to get the people you want to get into the company. So yeah, I'm a big fan of founders who say, look, this is the hiring plan, and actually either here are the individuals, and we're at this stage of the conversation with them. And it's hard. It's always a fine balance, right? And I think it's also a hard and fine balance when you start looking at those key hires. I like to, if someone does present that data and they're able to say, yeah, this is the individual we want for a head of marketing role, say, you go back and you look through their experience, and if you find that they've only ever worked at large corporates, you say, okay, are they really going to know how to deal with, a 5-person team where absolutely everything is on fire in this business, and how are they going to deal with that? Because that is the reality of pre-seed and seed startup life, right? So yeah, I think it's really important for that, because time to hire is never accounted for in runways and burn.
When you were saying that investors what they won't tell you is that they're choosing to not invest in you personally. Is there a way to get critical feedback from investors who won't say that, but they've passed on your round, and you sense that might, be part of the reason they said no?
Yeah, it's a really difficult question, because I think, and I'm happy for this to be on record as well, I think there are some really bad people, let alone investors in the space. I think giving feedback to an individual on, why you don't think they're strong is very, very hard to do, and it definitely cannot be done after 1 meeting or 2 meetings, right? You really need to understand that individual, and if that's the reason that you're not investing, you should always be clear and be honest. However, I think we're making the assumption here that the individuals delivering that feedback have actually either managed teams or know how to deal with people. And more often than not, an associate at a VC fund has never managed a team and doesn't understand, what to look for in kind of to create a 360-degree strength in a team. So I think asking for feedback shows a hell of a lot about who you are as a founder and who you are as a person. If you're open to that, it shows a very high degree of self-awareness, in my opinion. However, I would just be aware that the feedback you're likely to get is probably coming from a place of someone who either hasn't done anything, or it's going to be slightly skewed. So I would use that as maybe like a relationship builder or maintainer, rather than actually saying this is going to be kind of concrete feedback that I can use going forward. So, but it's a good question. I mean, asking for feedback is something that I notice all of our portfolio founders doing. All of the, and I mean that in terms of the angel portfolio that I have, and then also Hambro Perks as a fund as well. They're constantly looking to evolve, constantly self-aware, but they also know when to say, I am the best, and I am really good at this, and I am better than X, Y, and Z other person. So yeah, again, it all comes down to balance.
So let's talk about the pitch a little bit. At the start of a pitch, and this could be whether you're receiving a deck just cold, or whether it's your first time meeting a founder. What are the key things that founders can do within the first 60 seconds of their problem statement that kind of get you to think, okay, this is a big problem, I'm interested? And I ask that because a lot of the founders in our cohort, when talking about the problem, it's so difficult to talk about kind of the niche challenge you're trying to solve as phase one of your business. And so kind of if you paint that picture too strongly, it almost works against you, because further down the line, it's like, okay, well, I get this is a problem, but how is this a really big problem? So how can leaders kind of create a compelling problem statement in a short period of time?
Yeah, again, it's a great question and a big topic, but we could spend an hour on this topic alone, right? In terms of setting that up. So I guess the first thing I will say is that pitching and raising investment is nothing other than a sales process, right? It is a sales process. You're just working with a different customer base in this respect. I like to, when I say to founders, okay, you're going through this process, this is how I would approach it. I always look at it and say, you need to have a pitch deck, and then basically what I would consider like a review deck or a deep dive deck. The big difference is one gets you the phone call, and the other is for the investor that you're speaking to go away and do a deeper dive into the proposition itself. Going back to the point around cold outreach, don't be afraid to reach out to investors cold, whether that be by guessing their emails or getting their email off someone else, LinkedIn, whatever it is. I know lots of investors are like, oh, don't contact me here. Like, I'm sorry, but fuck, it's our job to meet with founders. So let's get over ourselves and make time for that. If that doesn't work and that cold outreach doesn't work, the best way to get in is through a portfolio founder. So go onto the website, find a portfolio company and say, okay, I saw that this company said, that they've invested in, I don't know, I'm trying to think of in our portfolio, Pepe, for example. Go away and see if you can get hold of the founders of Pepe, or someone high up in the team at Pepe. And the reason they say that is because what we're saying there is we backed Pepe, we backed the founding team, we backed them very early on. So we know the kinds of people that they are and how they're going to do it. So in this instance, if they're recommending you and they think that you're good, there's a high likelihood that we're going to say, yeah, sure, this person is strong. So, and that's where you kind of take the intro from there. I'm very lazy. I much prefer speaking to people. So for me, I would much rather just get on a call and figure things out from there rather than actually going through a 22-page deck. And this is why maybe I naturally gravitate towards this kind of pitch deck. But on the pitch deck, and I wrote about this on LinkedIn recently, there are 4 key questions to answer, right? Why now? So from a timing perspective, why now? Why you? Why this problem? So actually, what is this a big enough opportunity? And ultimately, like, somewhat into like how are you actually going to do this, so what are you actually presenting, and what are you going to do it. And it can literally be as simple as 4 slides. That's all it should be, because ultimately what you want is to leave an investor wanting to know more, wanting to go into more detail, and wanting that 22-page deck. In the same way you would run a sales process where you have an outreach, you understand the client, you come back in, you write a proposal, you then onboard, etc. It's the same with investors. You want to do that cold outreach or get that intro through a portfolio company. You then want them to have a look at a 4 to 5 page deck, and you then want them to get on a call. And it works, trust me, because ultimately investors are naturally inquisitive. We never want to miss out, so we never want to look at an opportunity and think, it's not like, oh yeah, there are so many unicorns out there that we can just afford to, don't worry about that one, we'll just go on to the next one. It doesn't work like that. Naturally you have to kind of want to know more. So that's how I would approach it. I would split the deck up in that way, and then I would run it like a sales process. The emphasis is always on, is always on getting the next call and moving through those steps. And how can I provide you with more info? How can I tell you more? What can I do to kind of support that process? Yeah.
Nice. Okay. Quick reminder, founders, we're going to move to Q&A shortly, because at around 2:40 we'll start the pitches. The pitch lineup is Tim, Daniel, then Ollie. I'll repeat that, but just wanted to give you all a heads up. And so anyone who does want to ask a question, raise your hand to ask it live. If not, put it in the chat and we'll go to that in a few minutes. In the meantime, you just kind of started to touch on that, but let's talk a little bit around FOMO. Obviously, FOMO is a bit more powerful in 2021, but is it still an influential factor for investors now?
For shit funds, yeah, I think it is. So I'm just being candid. I think funds who don't have original thought and say, you know what, we're really bullish in this sector and we're going to go after founders in that space, or we're going to go after companies operating in that space, then yeah, FOMO is a good way of investing. I just quite candid on that, because I think the VC market and the investor market is so commoditized. There's so many different funds now, so many different people doing some sort of variant of another theme, that it can be quite hard for founders to actually find someone in their area who talks their language and knows exactly what they're doing. So going back to the original point, ultimately I think FOMO has definitely changed, and I think investors are becoming far more focused and are going outbound. And I get a good example of this is we're very bullish on cybersecurity across all of our different investment verticals, because it's going to cost the global economy about $8 trillion this year in cybercrime. $150 billion was spent last year on addressing this issue. So there's a massive difference, right? But because of that, you think, okay, there's a large market opportunity there. So we are, and again, I'm sharing all of our trade secrets, but we're reaching out to the kind of senior people, or the people we think fit the founder entrepreneurial profile at companies like Palantir, right? Why would they not leave? Or CrowdStrike, or Darktrace, etc. And would they ever be interested in setting something up? And that's where, as an investor, you become far more thematic and far more driven with your own approach. The other thing is that FOMO implies that people do actually share deals, and the answer to that question is they don't. I think investors have this image, or founders have this image of investors just spending time together, out on the slopes in Maribel, just chatting, sharing deals the whole time. It really doesn't work like that. I have friends at tier 1 funds who, we go out and we'll chat, and we never really speak about deals. And the reason we never speak about deals is because if there's a 5 to 20 million pound round, these funds will easily do the whole thing on their own, and they're not bothered about investing with anyone else. It doesn't benefit them whatsoever. They want to be in this company, and they want to support this founder, so they will take the whole thing. And that's the way it works out. So yeah, maybe not the answer you're expecting, Anne, but FOMO I think is for the funds that don't have the original thought and aren't kind of driving their own investment thesis.
All right, I'm going to take a quick question from Hannah. This is a really good question. Is it worth responding / trying to change the mind of an investor if they said no, and you give a few reasons why they have said no?
Yeah, I mean, I'm a fan of when if you go back to a founder and say, look, this isn't for us because of X, Y, and Z, and they come back and say, well, look, I've got this piece of data that shows that you might be wrong, or actually if you think in this way it kind of works out this way. I'm a fan of that. Other investors who again, being candid, might be somewhat more insecure, would just be like, no, blanket no, it's definitely a no, we're not going to do that. So I think it comes down to probably the emotional intelligence and emotional maturity of the investor that you're speaking to. So to judge the situation, I don't think there's anything wrong with it. The best thing you can do is not ask for introductions, but to ask to keep the investor updated. And I like reading investor updates because I'm very happy for people to prove me wrong. And I'm happy for people to prove me wrong and founders to prove me wrong, because we have the luxury of being able to come in at a later round. So if I fuck up on the pre-seed, well, we can do the seed or the Series A, and I have no issue doing that. And you also learn a lot about a founder during that process. You learn how they think, and it just goes through that relationship building cycle. So yeah, I think, Hannah, it's a good question. I also think it depends on the quality of the no. So if they're just saying, yeah, no, too early for us or whatever, I wouldn't bother wasting your time on investors like that. But if they're coming back saying, well, look, I find this really challenging, or I don't understand this, or we couldn't get comfortable with this, then try and help them, try and walk them through the process. One of the things I like to do is, before the initial call, I will say to an investor, say to a founder, look, these are the 3 big things that are like massive red flags for me that I don't understand. So either I really don't understand this piece of cybersecurity, or the fact that your team is fractional, like that's going to be a big issue, or you're a Delaware co and we're looking at how much we invest outside of the UK, these sort of things, so that the founder can make the decision as to whether or not they want the call. Because ultimately, you've got to remember that all of the founders on this call are the ones creating value here. Like, we are just our investors are just custodians of capital. We're just investing capital that isn't even ours to give to you to go and create value. So we've got to be respectful of your time. And I don't think enough investors are like that. So yeah, sorry, long answer to that question, but hopefully that helps, Hannah.
No, I love that. I wish that more investors would say upfront, okay, these are the red flags that I'm seeing. Like, how do you approach that? Because we see a lot of the time founders pitch, and then the investor either ghosts them, or much further down the line will say, okay, well, this was after they said no, we'll say this was a problem for me, and the founder's like, I could have easily addressed that in like our first session, but it just never comes up. Okay, Jackie, I see your hands raised.
Yes. Hey guys, thanks so much. Sam, love your content on LinkedIn, learned so much from you there. So just kudos on that. I just wanted to ask a couple of questions, one with your investor hat on and the other with your founder hat on. For the women in the group who may be dealing with unconscious bias sometimes when we're pitching, just because you spoke so much about team. So obviously it would be great if I could say that we already scaled and exited a unicorn startup, or that my dad got to your dad, or whatever. Assuming you can't say that, so you have qualifications, which obviously you want to be able to mention. What is it really that we need to convey that would potentially, overcome any unconscious bias that somebody may not even know they have? They might make assumptions about you, but they may not even be aware that that hurdle is there somehow.
Yeah, I mean, I wish I had the golden bullet answer to that question. I think so. I'll be candid and say, so the big difference I've noticed between founders who identify as male, founders who identify as female in the way they pitch, and guys, I'm going to say how it is that ultimately men always pitch a vision, and they say, I'm here, we're going here, whereas women go, I'm here and this is what I've done. And it comes from this place of having to demonstrate where you've gotten to and how you've gotten there, to basically act as a validation piece. What you've got to remember is that investors are looking for that moonshot and that big piece. So you need to be aware of the way you're pitching and the way you're thinking about things, and say, okay, well, actually, it might not feel natural to me, or it might not come into the way I think about things, but actually I need to put the big vision and discuss that more, because ultimately that's what investors are buying into. More to your point, I mean, that's kind of on the point. The bias piece is very, very difficult. And I've studied, I mean, the Harvard Business Review, right? The research that they did into the questioning and the types of questioning that we see between male and female founders it's shocking, right? And there's no excuse for it, and there is no kind of golden bullet to sort it. What I would say is that there are inexcusable things to show that your business is moving forward. That's revenue, ultimately, growth, traction, etc., etc. Those are the things to show. If it comes down to your team, it's really about the belief in the individual and their ability to execute, especially at the early stages. So that's where you might want to show, okay, and this is where I think naturally women are better at it than men, is saying, okay, this is how we got here. We did all of these things, X, Y, and Z, and we got here. And then it's about kind of incorporating that into the vision as well. I don't think it answers your question though, Jackie, if I'm being totally honest. And I think it's a question.
It helps. I think it does actually. And I appreciate that, because I think you're probably right. Maybe we didn't previously have enough of where we're going, or being bold enough on, we know what we want to say, but I think we are conditioned a little bit to sort of underplay or play small or be polite, or we don't want to sound like you're bragging too much. And also maybe adding a bit more in terms of, the walls we've already, crashed through to get to where we're going, so that you can believe that we're going to continue to do that. So thanks for that. The other question is just, if with your founder hat on, so we were about to raise an angel round, was our intention, and then we attracted some VC interest because we had some viral traction. We're a B2C startup, so the growth element there was quite enticing for them. So we were taken to IC with one VC last week. We've some more this week. I'm just wondering your advice in terms of angel versus VC early on. Are there any sort of red flags around that, or do you think just take the money and run?
Good question. In this instance, I would say what you want is a VC to lead the round, and the reason for that is that they put things like governance in, they put structure in, and ultimately most angel investors, and this is a sweeping statement, so correct me if I'm wrong, Jackie, but a lot of angel investors really love a founder, love a problem, and they see the product, like they can touch and play with the product. But what they're not looking at is the roadmap, the way that this business is going to grow, the economics, the market opportunity, thinking about the exit environment, all of these things that kind of come into the technicalities of investing, but especially when you're investing someone else's money, right? It's easy to say, okay, as an angel, I'm just going to do it on my own. So I always like to say, and look, again, at HB, we have this luxury. Our pre-seed fund is an EIS fund. So what we do is we'll say, okay, look, we're going to lead the round, and then we're going to pull in industry angels around the company, and whether if they want to join the board and the founder wants that, great, that's excellent. If not, it doesn't bother us. Ultimately we want them on the cap table for a certain reason. So I would say try and have a VC fund lead the round, and then pull your angels in from there. There are quite a few sticking points from angels. They can get caught up on it, and you mentioned LinkedIn, and I've got something I'm writing about it this week. I'm just because I think there are a few sticking points that angels kind of come up to. So my gut feel would be to say, try and get the VC fund to lead the round. Get them on the cap table, and then have the angels kind of swarm in around that.
Super great, thank you so much.
Oh, and also, sorry, one point on that, let the angels take the SEIS, because what I found is that most SEIS funds will charge shit fees on that, which is bullshit, and is something that we need to call out more, and I would love to see founders talk about this more, like, I'm not going to name funds, but I think we all know them. They're saying they're going to do 250 grand, but then they're taking 10% off the top immediately. Then they're charging 2 or 3% annual monitoring fee going on forward. That's just ridiculous. Again, something that one of the only reasons why I joined, or one reason why I joined Hambro first, we don't charge any fees to founders. Nothing. There's a legal, the blanket legal, but that's for both sides and all angels to come in. So just be aware of that. I'd rather, let the angels take the SEIS, and then you'll find that most EIS funds should be relatively okay on fees, but it's normally the SEIS funds that are pretty bad.
Okay, great. Cheers.
Good. Thank you.
All right, Francisco.
Hi, Sam. Thanks
Hey.
for taking the time to speaking to us. I think there's a lot to be said about sort of red flags, both from VC, angel, and founders. Feels like this is a book that someone has to write with a lot of details and a lot of names. But I just wanted to hear from you some of the potential red flags that you have encountered when it comes to a cap table. Especially when it's sort of, companies like me, I've raised £400,000 from various angels, and now I'm thinking about my seeds to justify my growth and continue to grow, and obviously thinking about VCs and individuals such as yourself. Are there any red flags that we have encountered in regards to that cap table that founders should? Sorry.
No. It's a good question. You said this was a great group of founders, but these are really good questions. So the first one would be lots of different angels kind of coming in on loads of different valuations. And I know that sounds weird, but you can kind of work backwards from the cap table if you know how to. And you say, okay, well, this angel came in, then 2 weeks later, this one did, and the valuation went up. And then this one, you gave them a slightly better price because, I've known that person for years, or it's my uncle or my aunt, you know what I mean? So you start thinking, okay, this doesn't piece together very well. So there's that. There's the valuation piece. The second piece is share types, right? And the types of shares that individuals get. I'm a big believer that angel investors should get ordinary shares, especially if they're getting a tax relief. If you get an angel investor who's getting, a tax relief, either SEIS or EIS, and then they're also getting pref shares, essentially they're double dipping, and it's something that an investor will go, yeah, no, we don't really like that, because you start calculating the waterfalls, and big funds just go, yeah, no, we're not doing that. So that's the second thing. And the last thing, and this is something that I see a lot, is advisors being given way too much equity, like way too much equity. Again, I won't name the company, but the cyber company with the fractional team, the two individuals in that were like 2 days a week and 3 days a week, I think, and they were given 6% and 5% respectively of the business. That's way too much, way too much. And so it's really about managing that. And again, I've posted on it before, but I think Index were the ones who originally released the stats and the figures on this, but you'll find it on CB Insights as well. Most advisors should be at around 0.5 to maybe 1.5. If they're a technical individual, maybe 2%. That's it. So yeah, they're the big red flags that we see on cap tables there. And then, adding one more is the last thing is when you have a deck that says, yeah, we're co-founders, and then you go on and one person has 80% and then two people have 10%, and you go, well, hold on a sec, what happened here? And then, these individuals came on, slightly later, and therefore we gave them less equity. Well, hold on, you're all putting the same amount of hours in, the same amount of time, you've all taken big salary cuts. So if you're all sitting at the table in the same way, that it should be an even split. So that's those are the things I would look for and would be red flags to me.
Thank you. Thanks.
Good question. And our whole 3 p.m. session is going to be on red flags too. So hopefully we'll be able to touch on more there as well. Okay, Aidan, I'm going to go to you quickly, but we probably have about a minute until we need to start the first pitch, which is going to be Tim. So Tim, please be ready to go on screen share mode in like 60 seconds. And Aidan, go ahead and ask your question.
Don't worry, Sam and I know, so he doesn't need any background.
Yeah, hey Aidan, how you doing?
Already, but Sam, we've had some interest from a VC.
Cool.
We're still a little bit early stage for their fund, but they're looking to co-invest or co-lead with another VC. So we're looking at 500K. They've said, okay, for them to put in a 500, 250. They were looking for another VC to sort of come in and match that. And to co-lead. Is that something that sort of generally happens, and how do we go about approaching other VCs with that sort of?
I mean, there's so definitely wave that to other VCs and other investors and say, look, we've got 50% of the round, or the 250k committed, and is coming from a co-lead position. The reason, or my belief as to why VC funds like to co-lead is two things. One, it's far cheaper doing it that way. You don't have to pay for either legal and run your own legal process if you're not leading, because you're not the one drafting the long form docs. Secondly, some funds just don't know how to run the process, both from a legal perspective, but also from a valuation perspective. And that's the big thing I find, is that people go, all right, we'll follow on, but we're not going to price the round, because we haven't got a clue how we would go about doing that. But yeah, definitely wave it and show it around to some of the other funds and approach them. You might find that some funds that position themselves as co-investment vehicles or co-lead funds, they will go, okay, we're happy to lead this round. So some people can shift and can change, but definitely use that to your advantage as a way of kind of getting people to commit and get on board.
Okay, nice one. Cheers. Thanks for that.
And congrats. That's great news.
Yeah, thanks.
Your last email didn't say that.
No, don't worry. You'll get another one soon.
Cool.
All right, we're going to go to the first pitch. Each pitch will have 3 minutes to pitch, and then we'll do 3 minutes of Q&A/feedback. Okay, Tim, take it away.
Thanks, Sam. Sam, this is a 4-slide deck. I promise you. It looks like it's 12, but it's 4.
Love it.
After what you've just said. Let me start with the problem. So this is the B2B small business services market. So if you think HR, finance, legal, marketing, all the stuff that you need to run a small business. In the UK alone, there's about 5.5 million small businesses, and the value of this particular market is about 255 billion a year. Small businesses have a problem because they're time poor, resource constrained, and they need to buy in external help. They spend about 570 million hours just looking, and they waste about 51 billion buying the wrong advice from the wrong people. And the providers of business services, they have a problem as well, because they find it tough to sell to SMBs. It's tough for any business to sell to small businesses, but particularly if you're a small business yourself. Business development's time consuming, and digital ads and the like is an arms race now, which doesn't work for many of them. And they spend 31 billion a year on marketing and still struggle to be seen. The solution, we've got an idea in terms of what the solution is. Clearly, there's not enough time to go into this now, but we've got a staged approach, and it's all about bringing the ease and utility of B2C to this B2B market. So starting with an MVP, moving to a digital marketplace, and then moving to higher add value services further on down the line. We've already built the MVP. It's scrappy, but it's good enough to prove that there's product market fit. So what I mean by that is people are prepared to pay for it. So we've got our first paying subscribers, and the elements are great content, vetted providers, and then a community of people where they can ask for help and advice and share experiences. Why us? Well, I'm an exited founder myself and a former FTSE 250 CEO. So I've taken the business through from small beginnings to the FTSE 250. My co-founder Will is an expert advising big businesses and brands, and he helped Virgin Mobile go from launch to 2 million users. So we've got a track record of building big businesses and brands with lived experience of our market, both as buyers and sellers. And we like this because it's not very sexy. And that's great because it gives us a clear run at the rest. Why now? Well, small businesses productivity likes larger businesses, and the world's changed. So attitudes have changed. We're now used to remote working and remote service delivery, and B2C is recognized now as an inspiration for the consumerization of B2B. And small businesses, particularly the providers, are going to need new digital channels to get their business to market, including dedicated online marketplaces. Won't begin to address this, but there's lots of stuff out there: freelance sites, platforms, brokers, networks. It's messy, but there's nothing comparable. And over time, as we move through those stages of development, our differentiation gets stronger. In terms of go-to-market, I won't go into this, but it's hustle, digital marketing. We're making some good progress already. It's hustle to blitzscale land grab. And then traction. So we've been capital efficient to date. We're generating good leads, so our cost per lead, which is the white line there, you can see that's been optimized, and we're getting acceleration in terms of the number of subscriber leads. So this is people interested in listing on the platform and paying, and we're early revenue, so a million, I'd like to think so, 1,000 of monthly recurring revenue at the moment.
Hey, Tim, I'm going to jump in because we're 30 seconds over. So can you wrap up real quick?
Sorry, yeah, so it's just, we've got a big ambition, 100 million annual recurring revenue, 50-odd thousand subscribers paying an average of 152 a year. And we're currently in a fundraise, 600k. That'll take us to the 10 to 20k monthly recurring revenue. Thanks, Sam. Sorry I overran.
Nice.
Okay, let's do 2 minutes of feedback, and then Daniel, you'll be next.
Yeah, sure. So Tim, so I mean, a couple of questions. So first, or I guess a couple of points, and then that lead to questions. So firstly, marketplaces are having a bit of a rough time right now. And the reason for that is that the economics model can be tricky for most people. So just to understand, so you're actually charging the providers themselves to list on the platform, right?
Correct, yeah. It's free to businesses to use, but the providers pay to list.
Nice, okay. So it's not a transaction fee. That's not what you're charging.
No, we've moved away from, we didn't like the commission rate because you get disintermediation and people go around the back and whatever. Yeah, so it's a clear subscription model.
Yeah, cool. Okay, so that actually addresses one of the other questions I had, which was what. So one, I would definitely make that really clear, and that
Okay.
as you just said, means that you prevent any sort of leakage, because leakage is an absolutely huge issue. And the reason leakage is a huge issue is because you've got a dual-sided acquisition model here, right? Which, as you know, can be doubly as costly as just acquiring one customer from the immediate sense. So I guess you've had a go-to-market slide there, so I feel a bit bad saying it, but yeah, it would obviously be good to understand, that kind of process. The last thing I will say is that at the current stage of the business, I think the team slide should be the first thing, the kind of first, like, why you guys, right? And the reason I say that is because ultimately, the platform is likely to change. And investors know that, but if you can demonstrate the quality of yourselves as founders, which, clearly given the experience of both of you guys, you have a high caliber team there, investors are buying into that, right? And we say, okay, we're gonna back Tim, and Tim's gonna go and figure out this problem and this solution. So for me, it's the team, then the problem, and then the solution, and we roll it down from there. I hope that kind of helps, but
yeah, it's really helpful. So the team's been coming up the deck. It hasn't quite made it to the front, but maybe it should come right to the front.
Yeah, well, you got too much humility. Yeah, put it right at the top. Yeah, got to be the first thing. Yeah, no. And in terms of, drop me a message, and if I can help with intro to any marketplace focused funds, I definitely will. But as I say, unfortunately, people are like, bleh. But actually, it's not really a marketplace. Well, it is, but if you think about it, you're actually doing a B2B SaaS play. Because you're just an integrated stack. Yeah. So then, maybe I would think about that. But yeah, there we are.
Okay, thanks, Sam.
Awesome. Good pitch.
All right. Perfect. Thanks, Tim. Good job. Okay, Daniel, are you ready to go?
Yeah, I think so. Can you see my screen?
Not yet.
1 second. Okay.
Says you've started screen share mode. Just not showing anything yet. Do you want to hit exit and then try it again?
Yeah, sorry.
No problem.
That was this one. You see
Oh,
that?
Yeah, there we go.
Yes.
Perfect. Sorry about that. Thank you. Is that full screen for everyone? What's going on?
It's not.
Now hit the present. Down the bottom. So.
Teamwork. Thank you.
Look at that.
Hi, Sam. Thanks, everyone. Hello. I'm Daniel. I'm the CEO and co-founder of Beagle. We are on a mission to change how the world shops by helping people sniff out the sustainable option. Millions of people want to shop better, make better choices, shop more sustainably, but they struggle. We know from speaking to hundreds of our users that there are 3 things holding them back. Those are the price of the products and the alternatives that they look at, concerns about being greenwashed or lied to, and convenience. It's difficult to bring these things into their everyday habits.
Yeah.
So we're changing that by making it easier, cheaper, and faster for consumers to shop sustainably. So phase one was the Beagle button. This is a browser extension that automatically suggests sustainable alternatives as you shop online. We've got really low churn, consumers love us, great user reviews. We've working with 200 of the leading sustainable retailers here in the UK, and we've had great traction in the press as well. Currently, we've got about 2,500 weekly active users and a big community of people who are excited about what we're doing. Phase two is the rewards program for sustainable shopping. It's 2023, and it's insane to us that you can earn loyalty points for hotels, flights, and going to giant supermarket chains, but you can't for making better choices that limit the impact on the planet. We address the key consumer pain points that I mentioned. So exclusive discounts and cashback help users save money. We vet products, which saves our users time. And we do the research, which helps them avoid greenwashing. And we integrate seamlessly into the shopping experience, both with the browser extension and with the loyalty model. So how does it work? Users shop as normal, and then we pop up showing them an opportunity, giving them an opportunity to claim cashback on those purchases. This is an incentivized account creation. They come into the top of our funnel. Once they've created an account, they can shop, share, refer others to grow their rewards, and then they can spend those rewards on with participating retailers or for environmental projects like tree planting or ocean conservation. It's a huge market, right? Grew 1,000% in the last 20 years. And by 2030, 60% of the UK will be sustainable shoppers or eco-active. And in 2030, they don't call it sustainable shopping, they just call it shopping. We've got a unique advantage in the sense that we're the only people who sit on all of the data that we generate through the browser extension. And we think that leaves us as uniquely positioned to win in this space. But we want to work alongside some of the non-sustainable or traditional retailers to help their consumers make more sustainable choices as well. We have a clear path to profitability. So we generate revenue in 3 ways. The first is B2B partnerships. So we bring brands on board. And then we help consumers find products on our marketplace, and then we monetize the data and insights that we are uniquely positioned to generate as a browser extension. We've been delivering on our ambitious plans, so we've raised about 500K in pre-seed across 2 rounds, graduated from the Sustainable Ventures Accelerator program, successfully crowdfunded last year, and we recently became a fully certified B Corp. Our team are experienced startup founders and experts in the space, and we've recently brought on an advisor who was the CEO of Nectar 360, so very experienced in digital loyalty. It's a perfect storm. So big retailers or sustainable retailers are moving away from Google and big tech as trust declines, but there's a growing need for people for cost-efficient, cost-effective acquisition strategies. As that have gone up 222% in the last 8 years as consumers continue.
Daniel, sorry to interrupt. We're 20 seconds over, so wrap it up real quick.
That's the 4 slides coming back to me, but that's us. So yeah, people are still looking for products in this space, and we're looking to raise 1.25 million. We've got 100K committed already to help them do that. Thank you. All
right, wonderful. Okay, over to you, Sam.
Nice. No, Daniel, good pitch. Can you talk me through what you see as like the kind of key proprietary tech here, right? Because I get the browser extension, but like, where can you go from there? Is it in the data engine model? Is it understanding the customers? Is it understanding the purchase history? Like, where can you go and where can you take this?
Yeah, so a bit of everything. So I suppose on the one side, what consumers want is an app, right? And so we just launched our marketplace, which is a web app that's mobile enabled. A lot of the demand was when you're coming to Safari, when you're coming to mobile. So that's the next iteration of the product. But it's understanding that consumer and then being able to plug that back in to the retail side, which is the brand partners, and being able to say, well, this is a consumer. We understand what they're looking for, what they've bought previously. And so we can sell them unique insights about those consumers, but also the opportunity to get in front of them again through promotional campaigns, etc.
Okay, understood. Because I think that's a key thing that I thought. Well, I was just thinking as I was hearing it, and I realized it's just the first time we've ever met, and it's a 3-minute pitch, bang, bang, bang. Was okay. What is the kind of big proprietary tech here, and like where does the value come from? Because that ultimately is what an investor is investing in, and what an acquirer is acquiring, right? It is that you can build some sort of tech better than anyone else. The other question I have was just around the margin on the B2B play, because the marketplace margin is hard, as we've kind of alluded to already with Tim's pitch, like 10 to 20%. How do you build a big business there? Talk to me just about the B2B margins or the B2B economics.
Yeah, so we would charge on orders, so it's scalable. so that we can start working with brands, and as they grow, we can grow with them.
Okay, understood. All right, that makes sense. And then lastly, it was just a question around market, really. And I think this is the key thing that, we invest in sustainability and climate tech propositions. And one of the things that we're noticing now is anything focused around consumers and adoption of more sustainable shopping trends. There is greenwashing. Can't discount that at all, but people are and brands are so switched on to this that they are creating more and more sustainable, climate friendly solutions. So I guess my question, I'm just going to ask it how it is, like, what is the need for Beagle 3 to 5 years down the line when we get to a place where we would hope ultimately that everything is sustainable and that there aren't more sustainable things to purchase because we're at that kind of ceiling level? And I appreciate we're never going to get to that in 100% of the market, but hopefully you kind of see my point there.
Yeah, so I think hopefully, and our vision for that is that the same way that there's Nectar and Avios in this space, that's where we'll be, right? It'll be it'll be a normal part of everyday shopping, and we'll be the loyalty program that's catering to consumers in that space.
Okay, understood. All right. Well then, yeah, I mean, I think from my perspective, it comes back down to being able to demonstrate that key proprietary tech and where the value is really created. And then the other thing is from an economics model, ultimately let's take a £100 million GPLP fund, right? That they invest in you. Their hurdle rate is that they want to return the fund, which means this business, assuming they get in a sensible valuation and follow on and all those kind of variables, you need to be exiting for £1 billion. If we take an average multiple, you're looking at being able to basically do 72 million in ARR, right? So that's the golden figure. So if you say, okay, how the hell am I going to get to 72 million ARR? Does that come from marketplace? Is that B2B SaaS? That's where the economics fall in. And that is always a stress test for me as an investor is, okay, can this business get to 72 million ARR? Either it's not going to happen in a year, but it's going to happen in 5 years or 10 years from down the line. Does that make sense? So yeah, I think being able to demonstrate that is key, alongside that kind of proprietary tech piece and then market off as well. But yeah, sorry, I realized those are really specific, nitty gritty points, but
no, not at all. Thank you.
Trying to share it. So, but yeah,
cool. Thank you very much.
Well done.
We're going to try to get in our last pitch. Sam, would you have time if we ran 2 minutes over?
Yeah, we can run. Yeah, I mean, I'm only doing boring investor stuff after this. So yeah, no, let's do it.
Perfect. Okay, we do have our next investor coming right at 3 p.m. So we'll try to keep it really short, but we'll probably go a few minutes over. So Ollie, are you ready to go? Oh, you are. You're already on screen share mode. Love it.
Look at that.
I know, perfect.
Yes, I am.
Okay.
I'm going to try and keep it to 3 minutes, but we'll see how it goes. Good to see you, Sam. Everyone, I'm Ollie, co-founder of Whisper, where we're on a mission to democratize advertising by turning consumers into influencers. So in 2023, brands are struggling more than ever to reach and engage with consumers online. Influencers have stepped in as the de facto method to do so. However, they bring with them some major problems, including follower fraud, inauthenticity, and supply-side issues. As a result, consumers are no longer engaging as strongly, and marketers are seeing a decline in ROI year on year. So we're left with a highly inauthentic service that's costing brands more and more for worse results. And with influencers in limited supply, there's nowhere else to turn. Or is there? Introducing friendfluencing. At Whisper, we use the influence of the regular consumer to post on social media and spread the word about brands instead. Real consumers with real friends, who on average achieve over 10x the engagement rate of a standard influencer and are 5 times more likely to influence a purchase. This can result in up to 100% higher ROI and 100 times more UGC, as unlike influencers, they're in no short supply, totaling 90% of social media. Our 2-part proprietary software is totally unique: a mobile app for consumers to sign up, receive campaign invites, and become a friendfluencer, and a web app where agencies and brands can invite their consumers to become friendfluencers and manage campaigns. So demand is booming in this space, with 68% of brands increasing their influencer budgets this year alone, and new privacy rules imposed by tech giants such as Apple and Google have left brands scrambling for alternatives to increasingly expensive paid advertising channels. Whisper's consumer-driven model is the logical alternative in a cookieless world. So now influencer marketing is big money, but it's only set to grow. It's a $16.4 billion industry with a compound annual growth rate of 46%. It's set to be worth $51 billion by 2025. So not only can we take the current serviceable market by storm, but we're scaling with an emerging industry. Now, we found market and product validation, having completed over 55 plus campaigns with 10x industry standard results for brands and agencies like HelloFresh, Yo Sushi, and SGK, $1 billion global marketing agency. We've achieved 110K revenue since launch, and we're billing 10K monthly average revenue with a gross margin of 60%. Now, friendfluencing is a unique service, but we are seeing competitors testing less nuanced versions. Only Whisper offers brands a holistic software designed specifically for consumer application and market research at this scale. So through our newly launched SaaS model, we charge a monthly subscription fee and a margin per transaction. So each time a friendfluencer is paid, the higher subscription tier, the lower the margin. Our agency can handle all of it if they're over leveraged. So our core team expresses over 20 years of professional experience in branding, marketing, software development, and consumer services. And we've been awarded the best social media tool and young entrepreneurs at the UK Social Media Awards and Great British Entrepreneurship Awards as finalists. Alongside them, we have advisory support from leaders like Fitch, WPP, and Pernod Ricard, including our chair, David Blair, the ex-global CEO of Fitch, part of WPP. With the seed funding, we're aiming to sustainably grow to the UK market and reach a milestone of 100K monthly recurring revenue, reach profitability, and our expansion to the US and Australia. We're EIS eligible, and we're seeking 1.5 million growth capital to expand and scale our early traction and refine a product that marketers are obsessed with. Thank you very much.
Bravo. Okay, time for really quick feedback.
Ollie, that was super well polished. It always funny. We run EIS investor events for some of our portfolio companies, and it's always funny to see who's in the mode of like pitching and out fundraising and who isn't, because the way they pitch is totally different. So well done. Obviously we met recently and we spoke kind of at length about what you guys are building, and I find it interesting especially with cookies, iOS 14, and how that's impacted the space and digital ads. I guess the questions for me still remain around how you, from a brand perspective, how you ensure and what tech you have to ensure that the quality of the content is good enough, and how you do that at scale. There are AI solutions that enable you to do that, so kind of deploying that. One thing that wasn't clear from the deck is you kind of alluded to selling to agencies, or some of the best traction you've had is with agencies. Is that correct, or is it a bit of a mix of both, like agencies and brands?
Yeah, it's a mix of both so far, but we have identified agencies as one of our ICPs because they're looking to introduce new solutions to keep their brands engaged constantly. So we really like the idea of, we know a lot of agencies are doing like brand fan campaigns, but they're doing it very manually, and our software plug in and just make things way easier.
Okay, understood. No, that makes sense. And how, from an agency perspective, you talk about getting to 100K MRR. What does that look like in terms of like number of customers? Like how many customers do you actually have to get to achieve that figure?
Yeah, so I would say like at this point, we've not yet found like that commercial validation. So our pricing probably has a lot of adjustment to go. In our current pricing model, we don't think it's that many, but 50 to 100 brands, which we know is very achievable for a software like ours.
Yeah, okay, understood. And then I guess essentially the agencies are sitting there as almost like channel partners, right, in the way that you're going about, or you're billing direct to the agencies rather than billing out to the end customer.
Yeah, so for the agencies, we're just selling the software so they can introduce friendfluencing as a new channel.
Okay, understood. Yeah, well, and I think again, I probably similar to the point I gave to Daniel. I think demonstrating that the tech that you've built is super innovative, has a real big edge, and is actually going to enable people to like unlock some serious value. That's really what you want to be able to do, right? And that's how I would go about kind of putting it across to the investors. I also think that it's important in this space to demonstrate that there is like that longevity through the social media, through that channel. Not because I think social media platforms are going to go away. That's not what I'm saying at all. But I think ultimately people, if we get to this model of friendfluencing, right, which I agree, I think is hugely powerful, is at what point do a critical mass say, oh, that person, that friend that I have is just always trying to sell stuff, and I'm just not going to get rid of it. So they then have the same impact that the brands do, right, which is poor ROI. They're falling out of that kind of social engagement piece. I think it's very hard to replicate the kind of if I say to you, oh, you should go to this restaurant, or you should buy this product, or whatever, I think it can be quite hard to replicate that, especially to enable scale of it. So, but these are more existential problems that I'm kind of raising rather than anything else. So I apologize. But yeah, I think it's worth thinking about those things, because those are the things where investors will go, they'll say something like, oh, I just don't see the vision, or to me it doesn't make sense, something like that, right?
Yeah, 100%. Appreciate that feedback. And I do have answers, but I think we're tight on time. So
yeah. Well, drop me a note and we can chat about that.
Fantastic. Cheers, Sam.
And
Thank
I
you.
love the branded shirt that you have on, Ollie. You came ready for today. Love it.
So
Love
prepared.
Got to rep the merch, right?
Perfect. Okay, I'm going to stop the recording. We have our next